You are listening to KeyStone's Stock Talk Show, episode 254. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to be back. We will start the show with our poll question from last week on the proposed new capital gains tax in Canada, and I will give you a simple example detailing how the tax may affect your pocketbook. In our Your Stock Our Take segment, Aaron begins with a viewer question on A&W Royalties Income Fund, symbol AW.UN on the TSX, a California-based company that operates a quick service restaurant business throughout Canada. The stock, which pays a healthy 6.71% dividend, is down over 20% in the past year, and Aaron lets you know if today's price is a good entry point. Brennan will take a quick look at TD's Q2 2024 results, the recent anti-money laundering investigation by the Department of Justice, and how it can impede their growth in the U.S. He will also highlight their mortgage by remaining amortization, which will then, in his words, flow into some recent news in the Canadian mortgage space. Finally, Brett answers a viewer question on TerraVest Industries, Inc., symbol TVK on the TSX, a diversified industrial manufacturing company for multiple industries, including energy, agriculture, mining, transportation, and more. The company has 4 operating segments: its HVAC, compressed gas segment, processing equipment, and services. The stock is up a whopping 180% over the past year, and Brett lets you know if the good times can continue. All right, let's get to the show. We welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How you guys doing?
Good
weekend?
Good.
Yep. Good to hear. Aaron, on the weekend, you were on MoneyTalks with Mike Campbell. So how'd it go? What did you guys talk about? I have heard the
well, as always. Always enjoy the interview with Mike. He's a good interviewer. Asked the right questions. So we talked mostly about dividend stocks. Really what he kind of wanted to get into in the beginning was, looking at some of these companies, particularly in the telecom space, utility and REIT space, that have really high yields, like north of 7-8% even, and just discussing whether or not these were sustainable yields, if this is an opportunity an investor should get in for that level of income. So we kind of walked through a couple industries. I talked about our model in terms of focusing on companies that are not just paying a dividend, but also growing that dividend, and then the balance between the current dividend yield and the growth rate. So, if you want to hear the details, you can go check out the segment. But, really what I was trying to push home is that, the yield, just looking at the yield doesn't really tell you anything about the company. It's that maybe they are paying out a high dividend level right now. But it doesn't tell you about the sustainability of that dividend. It doesn't tell you anything about how the company can grow that dividend over time, what the risk level is. So if all the analysis was income dividend yield analysis was looking at the yield, then, my job would be super easy. But, it's really about going beyond that and looking deeply into the company, about, trying to find out whether or not that's a company that has the ability to grow the yield over time. And it's really that growth in the dividend that sets a dividend payer apart from a bond, right? Which just essentially pays an income distribution, which reflects the current interest rates, but does not compound growth over time. So those are the things we talked about. We talked about a couple recommendations, a few ones that I presented on the show for the first time, and then an update on one. So anybody interested, I suggest you take a look at the segment.
Yeah, we'll include it in the email that we send out to listeners. So if they're interested, they can take a peek and listen to you.
Yeah, for sure. And we did some quick work, just even on to dovetail off of that point, continue on that point on the effective yield of like some of the companies that pay dividends within our growth stock area of the research. And, kind of, I mean, we know this, we're really looking for capital gains there, but Hammond Power has been the best performing stock basically on the TSX for 5 years. But when we had recommended it during the pandemic, it was trading around the $6 range, 5, 6%, 5% dividend in that range. It just based, I mean, the stock has done tremendously well. It's $6 to 125, which in that range that it's trading at today. But the effective yield on that investment, because the dividend has also gone up 220+% over that time, your effective yield has gone from 5 or 6% to 18%. So if the stock does nothing, if you bought it 4 years ago, you're getting paid 18% per year. And we detailed the story of Dynacor, which is a company, we recommended between $1.80, $2. And that company had no dividend when we originally recommended it. The stock, we actually spoke with management, talked about, like Aaron talks about there, the benefits of a dividend growth stock for investors and how attractive that type of stock becomes. So they implemented a dividend originally, 2.5%, 3.5% in that range. Every year for the past 5 years, increased that dividend. I think it's more than tripled over that period. And you have an effective 8% plus yield on that stock from when we originally recommended. So it's very powerful in terms of buying a stock, having them grow that dividend over time. And I think Aaron was talking about that as a really powerful element to your investment equation. Anyways, anything else you want to talk about your weekends? Anything go on? No, you got nothing.
I had a good golf game, but I ended up blowing up on the back nine. But anyways, we don't need to get into
So it
it.
wasn't that good then, was it?
Yeah.
It wasn't that good. Well, the front nine was good, but the back nine,
Stay away from the wobbly pops till after, and maybe you won't be falling off the greens. Is that the issue?
I didn't have a drink. I literally didn't have a drink. I was drinking water the whole time.
Maybe you should have a couple more.
That is the issue.
On the flip side, right?
That could be something.
True.
Yeah. Also, the Oilers play tonight. I mean, everyone's going to be getting this on Tuesday.
And they did lose one over the weekend, which we didn't point out in respect to you, but now we will point out.
Yeah,
and
hopefully they can get
slightly.
Hopefully they can get it tonight. But again, everybody who's listening to this is going to know the verdict because this will come out tomorrow. But anyways, we can go into the show.
Yeah, excellent. We wanted to look at last week's poll, I believe, to start, Brett, and it was in regards to the capital gains, the new proposed capital gains tax.
Yeah, so a nice and simple question. Do you think the Canadian capital gains inclusion tax rate increase will impact the Canadian stock market? 62% of our viewers said yes, while 38% said no.
So if I could just start, I voted yes. And I mean, this is just anecdotally from hearing from clients. Like I had a call with a client last week and he was literally saying that he's planning on taking profit on a bunch of these names before basically it kicks in. So, that is one thing. And why I guess I voted that way. Again, he's looking at his portfolio and he's not just taking profit and trying to avoid the tax on any names. If it's a good company, still continue to hold that good company. But again, on names that maybe are, have maybe exposure to commodities or whatnot, he has been, taking profit there. So I do think that it may impact it a bit.
Yeah, and it probably would have, if it did, it would be.
I mean, presumably he's going to put that money back into the market.
Yep.
Yeah, the effect. And again, we just mentioned Hammond Power. Now, there's, we were talking pre-show. You can't show specific evidence of this, but, it was the day or so after this proposed tax was put in. Now, that stock is a stock where Canadians, our clients specifically who had invested in that stock over the past 5 years, it's the best performing stock on the entire Toronto Stock Exchange. It has some unique characteristics to it in that, relative to, say, a TD, it is relatively illiquid. I mean, it still trades in significant volume now that you can move in and out. But, that if there was a amount of investors pushing the sell button on one date, it could move the stock more significantly than a highly liquid name. So on those dates preceding, the stock actually came off significantly higher still than it was a year ago, 200% plus, but came off. It's since recovered to a degree. But I mean, you could have seen that with some people looking at, like, there was literally people, and we talked pre-show, looking at $1 million gain in the stock, for example. And if you thought you could save 100,000 plus in taxes, or in that range, then you may be making a decision. Now, I'll talk about this in a second in a segment. You should never make your decision really based on tax reasons. This is a kind of unique situation. And as far as investing in a company based on that or anything, you got to look at the underlying business, not the tax behind it or the tax situation. So, but yeah, Aaron, sorry, were you saying some more there? Or you?
Oh, I voted that it would, but I also want to qualify that by saying that I don't think that the impact to the market, the sustained impact to the market based on this one thing is going to be big enough that it's necessarily going to be measurable and traceable to it. But what I think is that this is one of many things that the Canadian government does, or just Canada does in general, which I think impacts our productivity and our attractiveness as an investment center over time, right? I mean, there's a lot of things that we need to work on. Competitive tax structure is one of those things. It's one of many. So while I don't think that this one thing is going to have a substantial impact on the market, that is, I mean, certainly on individual stocks in the near term, presumably for most Canadians, a lot of that money is going to go back into the market, into other companies. But certainly I just think it's a step in the wrong direction, where I think we should be encouraging investment and not discouraging it. As one of the ways, essentially, to improve the productivity situation here in Canada. That's my thought. So
yeah, and there's a short-term market fluctuation that we might see, but the long-term structural issues here are whether it's more attractive to set up a tech company here. Will we have the next, Shopify? The person who's sitting in their software development class right now, thinking of developing the next greatest software company or tech company, and are they going to say, you know what, I'll just incorporate this in the US?
Mm-hmm.
And then we don't have the next Shopify development.
And there's a million different other things that they'll consider as well, but this is this is one of them, right? It's one of them. So
yeah,
one
if that pushes them to go,
be the isn't going to be the single sole factor that that determine whether or not we become a center for investment and tech development and innovation. But it's a lot of small things that work together, and this is one of those small things. I think it's a step in the wrong direction.
And it's not just saying, oh, that person's greedy or whatever because they want to set it up in the US because they'll make more, or some other jurisdiction because they'll make more. The reality is, if you're looking to hire talent, the tech sector has historically had compensation through stock options. And if that's less attractive based on a capital gains tax here, you may not be able to garner or attract the same amount of talent in that firm if you're based here. So, these are things that have long-term ramifications. Yes, the government may be able to pull in some more tax over the near term, but is this a structurally good decision for a robust economy in the long term? Again, that'll be proved out over the long term. I'd argue against it.
Yeah, so I can add a couple things here. The way I see the near-term effect, I think it's going to be like an exasperated tax selling season. So normally in December, you'll start to see people sell things off for tax purposes. And that's across effectively every Western country. You'll see that to some degree. The degrees changes a bit, but that's something that you've seen throughout history. As well, just looking at the historic capital gain treatment in Canada, prior to 1972, there was no capital gains tax at all. It was tax-free. After that, till 1990, you had a 50%. Then from 1990 to 2000, you had a 75%. There was a bit of a interchange period there, but it was so. Then we dropped back down after that in 2000 for the next 24 years now at that 50%. So we had about a decade at 75%, and then it got reverted.
Yeah.
And during that time, obviously, we had that massive Canadian tech run-up, which obviously collapsed soon after. And we saw that with Nortel was obviously the headline name there. So it didn't inhibit those companies directly, at least because they were quite young at that time too. Remember, they really grew up in the early 90s and they became public companies in the late 90s. So it didn't directly inhibit them. So while I wouldn't argue against saying it, especially when it comes to the talent and stuff like that, that's, I would say, is the bigger issue is you need to have a way to attract talent within Canada. And one of those ways is obviously doing those stock options, doing those share issuances in whatever vehicle. But the capital gains tax alone is not the end all for attracting tech talent or whatever emerging industry talent. It's just one of the avenues which they can do. So the Canadian government, if that's what their goal is, which they've proven time and time again, they always say, we want tech companies in Canada, but they don't really do anything about it. They need to do something to attract the talent, especially when they're detracting in this manner.
Well, and if you keep going in that direction, higher personal tax rates, higher corporate rates, higher capital gains rates, I mean, eventually people throw their hands in the air and say, if I have somewhere else to start my company, perhaps I do that. I mean, I love living here, but if they're, if you're paying 20, 30% more tax somewhere or 15% more, and then, and the other the thing we just said, and you said it's very important, if you're not able to attract the talent that you need, then you can't have the business. Or you're going to have a business that will fail. All right. I'm going to talk a little bit about a simple example. So as you have already heard, in the budget 2024, the Canadian government has proposed to increase the capital gains tax for capital gains realized on or after June 25th, 2024, from 50% to 67%. This is not the tax you will pay, but rather how much of your gain will be taxed. The actual gain will depend on the size of the gain and your personal tax brackets. I'll go through an example below on this. Additionally, on the personal side versus the corporate side, there is first a hurdle of $250,000 per person of gain that will still fall under the 50% inclusion rate. At this point, we do not have any documentation showing what will officially become law and when. In fact, the government has pulled last-second reversals on several initiatives, including amendments to the firearms law. It would be great to see some written clarity, but we are in a holding pattern for now. In fact, the proposed capital gains tax changes were notably absent from the motion the Liberal government tabled to introduce Budget 2024 in the House of Commons. It appears that the government intends to ask Parliament to approve them in separate legislation. So the question is to do or not to do. That is your question here. Some individuals are wondering whether to sell assets with gains now versus after. Tax, in my opinion, and in our opinion specifically, should never drive your investment decisions. You want to consider the investment unto itself. Again, this is somewhat of a unique situation, but if you were planning to sell that asset, whether it be a house or an individual stock anyways, then it may make some sense depending on pricing to do it now. Now, I would say based on a high level net present value calculation using 5% after tax rate of return and the currently proposed tax rates, it may be more beneficial for the taxpayer to pay the income tax today at a lower inclusion rate if the taxpayer was otherwise intending to realize the capital gains within the next 5 years. Here's a simple example. If you are in the highest tax bracket, your rough change in tax after the first $250,000 of gain will be calculated as follows. This is a very basic example. Again, $100,000, that's the amount, or just that's $1,000 I'm going to use simply here. Amount over the $250,000. Total gain here is $251,000. So the inclusion rate, 67%. That would be $667 versus inclusion rate at 50% would be $500. So difference of $167 additional gain to be taxable. So we're going to use BC here because that's where we're based. At least I'm based there. The highest BC tax bracket for 2023 is 53.5%. So additional tax on the increased inclusion would be $89.35. Many business groups and private sector economists argue that raising taxes on capital gains disincentivizes investment and entrepreneurship. I would agree. We kind of talked about this in the last segment. And they are stating it would be unwise to move. This is at a time when the Bank of Canada has declared weak productivity growth and lackluster business investment as really a national emergency. What really bothers me, I mean, not paying more tax bothers me all the time. I think there should be a reasonable amount, but we already saw that high tax bracket amount there of 53.5%. To me, that's enough tax already that you're paying on your personal income. But I think it's very disingenuous to say this tax, and the government is out there saying this all the time, will only affect the ultra rich. This is not just a quip that they're saying. They have it in print, and the government data, they say, indicates only 0.13% of Canadians. That would be people with an average income of about 1.4 million a year are expected to pay more in personal income tax on their capital gains as a result of this change. I'd love to see the actual inputs on this. They're disingenuous, and I would say BS. Anecdotally, I'm just going to give you a quick example here, real world example. My neighbor has a house, a summer house that has been in the family for 50 years. It was bought for $20,000 50 years ago with after tax dollars, I'd add, and it's now worth about 1.4 million. They don't make 1.4 million a year. He wished they made a tenth of that, I believe, but they will be affected by this tax. If you take the $1.4 million sell price on this, minus their gain, minus the $20,000 initial purchase, that's 1.38 million. You take off that 250,000, 1.13 million is taxed at that new inclusion rate, 67% inclusion rate. That would be about roughly 757,000 taxable, versus the 50% inclusion rate would be 565,000. After the proposed tax increase at 53.5%, that's the highest tax rate in BC. That's tax paid of $404,000 roughly. Prior to the proposed tax, it'd be $302,000 on that additional amount. So $102,000 more. Again, that's a significant tax burden that they could be paying on that. And again, they don't make 1.4 million a year, and they're not the ultra rich. So I mean, it really boils my blood when I hear this tax is only going to affect the ultra rich. Maybe you're saying that on an annual basis, but many people have a family asset or a summer place or one stock. We were just talking about Hammond Power. That stock for our clients is up 20,000%. There's many clients that we know have very significant gains in that stock, and they will be affected by this. They don't all make 1.4 million a year. It's very disingenuous to say that this tax will only affect the super ultra or whatever you may call it risk. And it bothers me because it's going to affect everyday Canadians as well. So, I mean, that should be said.
Yeah. I mean, obviously we're not like a political podcast. We don't want to get into it too much, but it also kind of like boils my blood a little bit, just that they've pulled out, or the Liberals grinds my gears. Thank you. If I was Peter Griffin, just the fact that essentially they pulled the capital gains change from the initial budget bill, I believe. So essentially, the Conservatives have to take a stance on either if they like it or if they don't.
Seems to be some politicking for sure.
Exactly.
Yeah.
And it just kind of, drives me nuts or grinds my gears. But anyways, we'll leave it at that.
Yeah. Any further comments on that? Or are we good?
I would just say, like you're using an example as a house, I would say for stocks as well, is you can do a bit more structuring to your capital gains. So if you do have a Hammond Power level gain, you're planning on holding it, let's say you're planning to sell it in 5 years. So over that 5 years, you can structure your selling as, let's say, 20% of that a year, and keep under that capital gains limit of that 250,000. So then you can get that lower rate. Still, you can do that structuring with stocks, and a bit more financial planning obviously comes into that. And as well, obviously, though, if you don't want to sell the stock, don't do it just for that. It's only if you're planning to sell it anyways.
No, it's a good point. Of course, if for example, we came out with a sell on the stock because we thought, not that stock, but another stock, and we thought it was overvalued. I mean, you'd want to be selling it then, and it's harder to do the tax planning structure. If we knew it was going to stay at, say, Hammond Power, $125, you could do that over time. But it's if you thought, well, now this stock is significantly overvalued, that's why we have to be taking advantage of it. But again, those are kind of one-time type scenarios that are occurring right now. But yeah, it is anytime you're paying, I just look at paying as, if you're paying 50% already personally, and then we're adding to that, again, the capital gain is after tax dollars. Like, you've already been taxed on that. And that, to me, I don't love getting taxed on something I've already been taxed on. And we
Sure
could
you
go over and over on that one, but we're not going to. All right, Aaron, you're gonna look at A&W. I think I had some A&W recently. I think I had a chubby chicken burger.
Nice.
Pretty good.
Let's get into this A&W Revenue Royalties Income Fund. Just talking about this company makes me want to go have some lunch. So I'm going to go through this. Quick so we can all get out of here. No, we'll be thorough. So A&W Revenue Royalties Income Fund, symbol AW.UN, on the Toronto Stock Exchange, trading at about $28.80 per share. It's a $420 million market cap company and is paying a very attractive yield right now of 6.7%. So what they are is they're a trust that was established to invest in the A&W trademark. So essentially what they are is they're a royalty company. They receive royalties equal to 3% of the gross sales reported by A&W restaurants that are in their restaurant pool. And that was 1,047 restaurant locations as of the end of Q1 2024. So this largely constitutes, I believe, all of the A&Ws across Canada. I think that there's a couple that aren't in the royalty pool, but this would be in my based on my research, well over 90% of the total restaurants in Canada. So looking at the company's performance over the last year, not great performance here for shareholders, down from $36 12 months ago to about $29 right now. So what's going on here with the company? We followed A&W for years, and it has in the past shown itself to be a very robust, very stable company and a consistent grower of its distribution. But recently we have seen growth slow. So Q1 2024 financial highlight, same-store sales growth was 0.6% in the first quarter compared to 6.1% in the first quarter last year. So same-store sales growth, this is a key metric whenever you're looking at a restaurant business. How much are they able to increase their sales from those same locations without having to add additional locations on? So we've seen that has pulled back. That growth level has pulled back. The number of restaurants continues to increase, albeit marginally. 1,047 restaurants as of the end of the first quarter of this year, compared to 1,037 a year ago. That's about 0.9%, so just under 1% growth year over year. Distributable cash flow per unit down 2.3%, and then the payout ratio 114% compared to 113. So, pretty stable there on the payout ratio. One thing I will note about the payout ratio, yes, it is over 100%. There is some seasonality to the business. So that's why in the first quarter, we generally do see that payout ratio a little bit higher. In addition, as a royalty company, A&W is expected to pay a high percentage of its distributable cash flow. So usually, for these companies, we're seeing in that 95% range. For typical corporate structures, that would be too high. But for royalty companies, they tend to be paying out a high percentage of free cash flow is the model. So there's really looking at a company like A&W, there's really two main things that we're looking at in terms of long-term growth. One is how are they expanding their network of restaurants? The second is the same-store sales growth. So looking at the number of restaurants in the royalty pool, we can see that consistently it is growing over time. So that's a good sign, albeit again at a fairly slow rate. So about 1% in this quarter year over year. But it is moving in the right direction. So that's a positive. And then looking at same-store sales growth. So when we look at the annual numbers, A&W is actually a company that really has a tremendous track record in the past of having high same-store sales. And the way they were able to achieve this was really largely through innovation in their menu. So they were one of the first companies, I believe they were the first fast food restaurant in Canada to have a vegetable based or a veggie based burger on the menu. So they used the Beyond Meat burger patties as part of their menu offering, and that really increased sales. There's other innovations that they'd introduced to the menu, so they've been very successful in this regard. And at times we looked at them in the past with double-digit same-store sales growth, and while that was great, we always felt that was kind of unsustainable. But we have seen that number start to trend down just recently. So during the pandemic, 2020, obviously they got hit very hard. Then 2021, there was a big recovery in the business, but we've seen from 2022 to 2023 that same store sales really start to trend down from 7.4 to 2.7%. And then we've also seen that continue into the first quarter of this year. So again, 0.6% for the quarter compared to 6.1% last year. But it's really started to trend down. And what management is saying is that a lot of this has to do with higher interest rates, less discretionary income for people to go out and eat. So that's likely the cause. There's also, a maturing of the same store sales. There's only so much innovation they can do to the menu to maintain really high same store sales. So right now they're probably at 0.6%, trending lower than what we would consider to be a long-term average. But I think that, the low single digit to mid single digit would probably be a good target for them longer term. And then, of course, annual distributions, payout ratio. So one of the things we've always liked about the company is that it's been a consistent grower of its income distribution. Now, they did cut the distribution during COVID because they took such a temporary hit to the business, but then they increased that during the recovery from COVID. But before that, we saw consistent growth, mostly from 2014 to 2020 almost, in the dividend, then the cut during COVID, then growth again. But just over the last year and a half, 2 years here, they have not actually grown their income distribution. And that's probably because growth has just slowed in the underlying business. So they have not increased it so far in 2024. They did not increase it at all in 2023. So that's a sign that maybe that consistent annual growth is coming to an end, and the increases are going to be more sporadic in the future. And then just with payout ratio, we can see here, right now they're really kind of at that on a trailing 12-month basis, that 93%, which is probably where we would expect them to be, kind of in the 90 to 95% payout ratio range. So that's fairly as expected. In terms of future innovations in the menu, they did just make an announcement recently in the last day or two. They announced that they entered into a long-term development plan with Pret a Manger, which is it's a global sandwich chain. So this is following the completion of a 2-year trial period that was announced in 2022. So what they've done is they added some Pret items to the menu. They did a couple of pop-ups at certain A&W restaurants, and they've also expanded to the first standalone Pret location in downtown Toronto in 2024. So they're looking to continue this over the next 10 years, adding Pret menu items to A&W, and then the pop-ups in the standalone restaurants. So now, in terms of what does this mean to AW.UN, because we really have to separate A&W restaurants from A&W Revenue Royalty Income Fund, which is what you as an investor would be buying if you bought AW.UN. So AW.UN does not own the A&W business. They only invest in the trademark. So they will receive 3% royalties on any products that are sold within A&W restaurants in their royalty pool, but they will not receive royalties on any new restaurants, Pret standalone restaurants that are built. So that's something that we think is, this is a net positive, just continuing to innovate that menu, but it's not anything that we think is going to have a substantial difference in the company's growth outlook over the next couple of years. So what is our take on the company? Well, we like it overall. We think it's good fundamentals. It's a national brand. The quick service space has really generally demonstrated more resilience to economic downturns relative to other restaurant classes, like the mid-range restaurant group, like you say would maybe be a Boston Pizza or a Keg. A&W has a very strong yield, 6.7%. And we like the revenue royalty structure. So they're getting a piece of the top line revenue. And this is just a very clean structure, and it insulates AW.UN from a lot of like the operational risks. So in terms of things like higher labor costs, that's something that does not impact their royalties, the royalties that they receive. But then on the negative, growth has certainly slowed significantly. And we think that long term, investors should be more accustomed to that low to mid single digit long term growth rate. High payout ratio, again, this is part of the royalty model, but at the same time, we do have to recognize that if they do take a hit to the business, there's not a lot of margin of safety there. We have not seen the distribution increase again over the last 1.5 to 2 years. So that's a change from the historical policy. And then, of course, there is negative share price momentum on the stock right now, which can be both an opportunity if we're buying it at a higher yield and a lower valuation, but it's certainly trending in that direction. So in conclusion, I mean, ultimately, we like the business. We think the fundamentals are positive, but we do have concerns about the future growth. It's a decent stock to invest in for yield if that's what you're looking for. Certainly, I think there's some upside to the stock as bond yields start to come down with interest rates, making the dividend yields, these high yield companies, look more attractive. But right now, in terms of just a stock investment, we think it's close to fair value. So somebody who wants to just purchase it as a non-core position for the income yield, it makes sense, but it's certainly not something we consider to be a growth stock at this time.
So more like 6.7% plus maybe a 3% dividend increase, 3 to 4% dividend increase. So maybe 9 to 10%.
Well, but right now they're not increasing the dividend at all, right?
Would you expect that over time to go
back? I mean, I would probably expect kind of like maybe the 3%.
Yeah.
Right. So maybe you're pushing up on that 10% total return, current yield plus growth. But as I said, I mean, it's been there is no increases through 2023 or so far in 2024. So I'm not sure when they're going to reinstate that trend.
Yeah, for the last 20 years, you're averaging 3% growth for the dividend. So that'll be, I would say, a nice long-term average you should be looking towards.
Yeah.
Good.
Yeah, just like side note too, it's just crazy to see like the boom and bust of like Beyond Meat as well. Like, I mean, again, it's not that it's completely a bust, I guess, but just the growth that we saw as all of a sudden these plant-based meats were coming to the market. Everybody wanted to try them. I mean, revenue on Beyond Meat was down, I believe, 18% in the last quarter. They're guiding for this year, I believe, at the midpoint, a 4% decline in revenue. They're still not profitable. Anyways, that's just a tangent just because Aaron brought it up briefly. But, we had a lot of questions on Beyond Meat.
Well, I like the Beyond Meat burgers. I think that they're tasty.
I've had
burgers.
them too.
But when I was, and I'll admit, I didn't do a lot of research on it. But based on the research that I did, it wasn't really clear that they were more healthy than a beef burger, right? So for that reason, it's great if you're a vegetarian for maybe ethical reasons or something, you don't want to eat meat. But if you're looking for a healthier alternative, it wasn't clear to me that it actually was healthier. So,
All right, well, let's move on now that we're all hungry. TD. You want to look at TD generally and the kind of their mortgages. 2024 results, Q2 anti-money laundering investigation by the Department of Justice in the U.S., and then you're gonna flow into some conversation about mortgage renewals.
So I've been doing a recurring segment on the podcast since May of 2023, so about a year ago, which was spurred when I discovered that Canadian banks were beginning to extend mortgage amortization periods on outstanding mortgages to essentially help ease the pain of some Canadians facing higher interest rates and ongoing inflationary pressures. But over the second half of 2023, banks were beginning to get this under control. So again, just to preface it for my segment, I'm going to quickly look at TD's Q2 2024 results, the recent anti-money laundering investigation by the Department of Justice, how it could potentially impede their growth in the U.S., and then I'll highlight their mortgages by remaining amortization, which will then flow into looking at some recent news in the Canadian mortgage space. So first off here, just looking at the financials, Q2 of 2024, revenue grew, or this is for TD, revenue grew 10% year over year, and this was driven by momentum in its markets-driven businesses and higher volumes and margins in Canadian personal and commercial banking. Adjusted EPS was up 6.8% to $2.04 for Q2 and declined 2.4% year to date to $4.04. And provisions for credit losses were about $1.07 billion, an increase of 58%, which was in line with TD's guidance. And if you remember last time I did the segment in late 2023, provisions for credit losses were actually much higher than expected by analysts, which was a common theme among the banks. So for fiscal 2024, management believes it will be challenging for the bank to meet its medium-term adjusted EPS growth target range of 7 to 10% and return on equity target of 16+%. Now, the bank also has a 2027 target of adding 150 additional branches in the U.S. However, given the U.S. Department of Justice investigation on how Chinese drug traffickers allegedly used the bank to launder $653 million US and bribed TD employees to do so, this growth in U.S. branches and U.S. assets could potentially be hampered. Now, TD noted that it set aside about $450 million US to be paid to one of the regulators and is bracing for other fines, with some analysts indicating that fines could be upward of $1 billion. Now, TD's management said in their conference call that while growing their branches is important for longer-term growth in the U.S., in the short term, they are focused on their digital and mobile strategies. And on May 3rd, the bank announced that the overhaul of its anti-money laundering program is underway, with the bank investing over $500 million in program remediation and platform enhancements. And as well, I brought this up at the end of 2023, but TD initiated a restructuring program, which is expected to generate approximately 400 million Canadian in pre-tax in savings in fiscal 2024, and an annual run rate savings of approximately 725 million Canadian pre-tax. And management noted that they are on track to achieve these savings. Now, looking at the mortgages by remaining amortization, we are seeing the number of mortgages with an amortization period of greater than 30 years come down to about 17.9% of all Canadian mortgages. That's basically, you can't see it on the screen. I was going to just show you where it is. I'll get Brett to highlight it for you so you can see exactly what I'm looking at. And this is down from about 21% from October of 2023. But again, just as a reminder, there were 0 mortgages which had an amortization of greater than 30 years in October of 2021. So while it is improving, if we compare it to 2.5 years ago when rates were significantly lower, it continues to be at elevated levels. Now, while outstanding mortgages with an amortization of greater than 30 years are declining on the bank's books, the Liberal federal government announced that it would now allow first-time home buyers to take out an insured mortgage amortized over 30 years, up from the traditional 25 years. And the move will take place on August 1st of 2024 and will allow Canadians to essentially lower their overall monthly mortgage costs on the loan. However, of course, over the long run, it means that borrowers will have to pay more in interest. So here is a quick example to show how much more interest one would be paying on a $400,000 mortgage if they extended their amortization period to 30 years rather than the conventional 25-year mortgage. So for my example, I'm using the assumption of a 5% interest rate. And for the 25-year mortgage, a borrower's monthly payment would be about $191 more than the 30-year mortgage. But over the life of the mortgage, a borrower would be paying about $71,000 more in interest. So while the Liberals may be making it easier for Canadians to purchase a home, it is in fact costing Canadians about 24% more in interest over the long run on my specific example here. Now, We have talked about this before, given the elevated interest rates, but just to finish up my segment and open it up to the guys here, the Canadian watchdog OSFI released last week that 76% of outstanding residential mortgages as of February will be coming up for renewal by the end of 2026, with about 15% of those mortgages having variable rates. So the longer rates stay elevated here, the longer those households will be dealing with the looming financial strain. I know we've been talking about it before. A lot of people have been talking about it. When is this pain going to be coming? There may be more pain potentially coming here. But yeah, so I guess that is essentially it. And I will open it up to the guys if they have any comments on TD or just mortgages in general.
Well, it's interesting the 76% of mortgages due in 2026, because I mean, I have read that there are a high percentage due in 2026. I didn't get that exact percentage, so that's interesting to know, and it makes sense because if you think most people do a 5-year term, that brings you back to 2021, right?
Yeah.
When rates were much lower. So.
Yeah, exactly. I mean, I have two friends that, I'm sure I've said this on the podcast before, but two friends that, it was like either 2020 or 2021 when they bought their homes, so they're in the same, pool there.
Part of that would be people were opting over the last couple of years now for shorter term mortgages with the expectation interest rates are going to go down.
This is true.
And just, the 5-year rates, they do have those embedded in it, the expectation that it will go down. That's why you'll see a 5-year rate right now will actually be lower than a 3-year rate or a 2 or a 1 year. And that means that banks and the entire bond market, fixed income market expect rates to go down. So you're not exactly playing the market if you are thinking that, because I have seen that occasionally online. But
good point.
Overall,
you're making the assumption that the rates are going to come down more than what.
Yeah, exactly. That's really what you're betting on. Not that they're just going to come down. It's more than the expectations, and that's. But a lot of people were saying, "Oh, it's just they're going to come down." I should say they're taking a more simplified view than what's actually going on. The banks have outsmarted you, unfortunately, and they probably still will for that.
Well, it's like going to Vegas and trying to outsmart the casinos.
Exactly.
Like they've been at this for a while. Like it's that's an uphill battle. So if you think you're smarter than the casino or the bank, then there's a problem.
I did it my last time in Vegas, so just kidding.
That wasn't even your money. I think so.
I'm just being a bozo.
Something was smart there. Yeah. All right. Let's move on that note. I don't think we have anything else to hit on that at this point, but I'm sure we'll be revisiting the mortgage story several times over the course of this year and going into 2025 and 2026. Let's look at TerraVest Industries. Company's done tremendously well over the past year and really over the long term. Brett, you're going to take that one.
Yes. So TerraVest Industries, symbol TVK on the TSX, is a diversified industrial manufacturing company for multiple industries, including energy, agriculture, mining, transportation, and more. The company has 4 operating segments: HVAC, compressed gas equipment, processing equipment, and services. I will say, though, they do lean towards that energy sector. TerraVest currently trades at $77.50, a whopping 180% increase over the past year, and that results in a market cap of $1.5 billion. So quite a good year for the stock, to say the least, up 180%. However, zooming out even more at the 5-year chart, the stock has risen 488%. When you see a price rise like this dramatic, or even less than this, but still quite dramatic, you really need to start to question, how do the fundamentals support the price? Even if it's still a good business or has become a good business during that time, that doesn't necessarily mean the fundamentals actually support the price. So looking at the last quarter, fiscal Q2 2024, ending March 31st, the company had strong sales growth of 22% to $215 million from $177 million. However, the sales growth is really just due to that acquisition of LV Energy Services and Highland Tank Holdings over the late last year. So removing the impact of those acquisitions, there was actually a decline in sales for organic sales. So that doesn't count the acquisitions. So that declined by 4%. So no organic growth, and it was just purely acquisition-driven growth. Notably, however, gross margin has increased substantially to about 30% from 25% in the prior year. You do see that shift quarter over quarter. because of seasonality. However, this shift is in part due to acquisitions as well, product mix and cost controls, and that's obviously something good to see, a higher gross profit margin. The gross profit margin really was the increasing force between the growth and the bottom line over the past year, as well as the sales growth, of course. The other significant item, however, that really impacted net income was an increase in other gains, which was primarily related to foreign exchange gain and gain on disposal of equipment, both of which are non-recurring. FX management will some years have massive gains or massive losses, especially when they have holdings in other currencies or other countries. So that's not something that they're really doing. So you normally want to watch for that, because occasionally you'll see a massive gain and that props them up into net income, not necessarily in TerraVest case, but just in general. Increases in foreign exchange or decreases, you really need to take note of that, because that is something that they have absolutely no part in. Unless they're, of course, hedging it, and that's something else you want to look into. But net income income attributable to common shares increased 152% to $22.4 million, and diluted EPS grew to $1.19 for 49 cents. So obviously big increases, but part of that is due to those gains. And for the non-GAAP metrics, TerraVest adjusted EBITDA increased 36% to $44 million, and cash available for distribution increased 29% to $22.6 million. As well, the company does pay a quarterly dividend of about 15 cents, or a yield of 0.8%, which of course has dropped due to the share price over this time. As share price goes up, yield goes down unless there's a correlated or the same dividend payment increase over the same time period. The dividend has increased over the past couple of years from 10 cents, but the share price has just outpaced it, so that's why you end up with that lower yield compared to about 2% a couple of years ago. Moving to the balance sheet, the company does have significant net debt and leases at this time. Debt of $281 million, leases of $100 million, partially offset by some cash, $18 million, resulting in a net debt and lease position of $364 million. However, after the quarter's end, the company has placed $96.5 million in shares at $74.25 a piece, so they're raising money. The placement was initially lower. A lower placement was expected at $65 million and then was raised to $84 million. Plus, there's a standard option for the underwriters to exercise, which allows them to overallot. In other means, they are able to purchase more shares and then sell them at their own discretion at the same price as the offering. And this option was executed fully, which normally means the market was really looking for these shares at this price. And that is something you want to look into when you do see these issuances. If it's over allotted, under allotted, or wasn't even fully subscribed, that is something that you can tell to gauge the market's acceptance of a capital raise. And in this case, the share price remained above the issuance price. So that normally means the market accepted the raise. But on the other hand, if you saw it drop 20 or 30%, which you do sometimes see with these capital raises, the market isn't accepting of it. And it can just generally be it was priced too low. They don't actually need the capital. Many reasons. But I digress. The additional cash will really be used for debt repayment and general uses. The prior acquisitions, which I was talking about, was $95 million. So this really just offsets that increase in debt. So I wouldn't be surprised if they're just doing it to clean off that debt of their balance sheet, as they are levered. Incorporating this pro forma net debt, the net debt to EBITDA ratio is about 1.8 times based on trailing figures. Assuming all else holding equals, you'll likely see a drop over the next quarter as the company laps results that were done prior to these acquisitions. Moving to valuations, the company has a trailing P of 24 times and an adjusted EV to EBITDA of 12 times. Neither of these are exactly cheap valuations given the low, or in this last quarter, negative organic growth. A couple of other factors I'll just quickly highlight to do with the company's underlying operations. The company financials are seasonal, with fiscal Q3 being significantly weaker due to all of its four segments being seasonally weaker during the Q3, which is the next quarter, as they are moved up a quarter. Although not purely dependent on Canadian energy market, is still significantly influenced by the sector. For example, the service segment is effectively all, but then if you go to the HVAC, it's less so. But it's very closely tied to the Canadian energy market, but not absolutely like you'd see like with an oil or a gas service company like that. So you will have some cyclicality just connected to Canadian energy. So if you're not wanting to be exposed to that, you obviously don't want to be exposed to TerraVest, but if you do want exposure, it can be obviously an option. As well, if you saw like a 2014 Canadian oil and gas market explosion. TerraVest wouldn't likely implode overnight like some of those companies, but it would be significantly impacted. It could go into negative earnings and so on. But it's not one of those overnight cases where if oil goes down, they disappear. Additionally, I would like to point out, as management has continuously highlighted, the company is still facing labor shortages, which obviously can impact costs and so on, and as well as output if there's significant shortages. Concluding, at this time, TerraVest is just expensive due to the lack of organic growth and is trading at a higher multiple. So just off the valuation and the risk-reward sentiment, it's just too high at this time. The company has improved its balance sheet, which is nice to see, especially with its capital raise at effectively an all-time high price. But the leverage is still a touch high given the cyclical and even seasonal nature at 1.8 times. It's more reasonable than what would be over 2 times without the recent capital raise, but it's still a touch high, but not extremely high. It's not the end of the world either. I would either like to see the valuation or a lower price to even consider entering a position in the company at this time, assuming the fundamentals stay relatively similar, or of course, seeing better organic growth. Given the risks of the company at this time, you need to see that trade-off become a better trade-off than what it is at this time.
Yeah, no, I think it's a good summary on the business. I think the crux of the argument comes in is, can you get some organic growth? If you had more significant organic growth, maybe you could, those valuations would make a little more sense. It has been built with debt over time. Debt continues to increase. Debt as a percentage of cash flow is something you want to continue to watch. But, you know, I'm not saying this is happening with TerraVest at all, but we've seen some of these situations built with debt over time. They're built with debt until they can't be built with debt, and then you don't have any organic growth in the business, and then you see a problem. So because you have no organic growth, the only way you can, and if there's some access to debt, either becomes lesser, or you're just extended the balance sheet to the point where you can't access debt at reasonable prices, then it becomes a problem. So again, it's something we'd monitor with TerraVest. It is certainly a long-term success story, and the business is admirable in the way they've built it over time. Just love to see a little more organic growth.
Yeah, I quickly, just as a side note too, I quickly pulled out like that 6 million in other cost and calculated like in the last quarter, so like an adjusted EPS basically of like 87 or 88 cents essentially, which I mean still year over year is like 75% growth. So again, rather than, and this is basic, not fully diluted.
Mm-hmm.
So just FYI, but yeah, if anyone's curious, I just quickly ran that on my calculator while I was listening. Good job,
So
Brett.
what was the growth level?
It was 75% on basic
strong.
EPS. So it went
Very strong.
to, about 87.5 cents in the last quarter from 50 cents. Same time last year.
Okay, excellent. All right, well, I think that'll close out the show for this week. If you want to listen to Aaron's appearance on Money Talks with Mike Campbell, I think we're going to put a link into the distribution of this email, and into, if you're watching it on YouTube right now, it should be below in the section below, and you can click on that and grab and listen to Aaron on Money Talks. Again, if you are watching us on YouTube, smash that subscribe button. If you're viewing this or listening to this on anywhere that you consume your podcast, continue to rate and review us. If it's on iTunes, like I say, as always, we look for positive reviews. Thank you very much. And again, I'm going to wish you profitable investing.
Great. Thank you, everyone.
Thanks, everyone.
Thank you.